Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is March 14, 2023. It's a Tuesday, and it has been a wild few days, folks, since we've had the last show. So today, we're dedicating this show completely to that. What has happened that we've had two major bank collapses? What about this morning's CPI? What does that mean for the Fed next week? We're going to dive into all that and what you should be watching in the stock market, bond market, cryptos, you name it. What's moving, why it's moving, and where it goes from here. All that and more coming up right now on Making Money. Most investors never touch this segment of the market, but according to the latest analysis from our team at Stansberry Research, this is the number one most important sector to pay attention to in 2023. And we're urging you to move your money immediately. You can stay one step ahead of the market, potentially unlock extraordinary gains just by understanding why this sector is set to boom. I strongly encourage you to read our analysis totally free today. It's all spelled out in a free report we just put together. Get the facts yourself. Go to hiddensector2023.com to get your free copy of this report. You can learn how to profit from the untapped potential in this hidden sector before it becomes widely known. Again, that's hiddensector2023.com for a free copy of our new report. Again, welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 14th of March, 2023. And it's a beautiful day out, but it's been one hell of a wild ride since basically last week or last 7 or so days. We're going to get into some of the details of what happened with Silicon Valley Bank that spread over to Signature Bank. We've seen a lot of other regional banks get absolutely demolished. We've seen the market be crazy with the VIX hitting the highest level in months, meaning volatility's hit the highest level in months yesterday. We've got a lot that we have to dive into, and I'm going to kind of break the story down to you, but then more importantly, what it means to you and try to explain it in a very simple way, because whether you're looking on Twitter, whether you're turning into the nightly news, whether you're following some financial website or guru, you're going to get a different view from everybody. And my view might be a bit different, but I'm going to try to give you the most unbiased view as possible of what's going on and let you make your decision from there, whether you want to panic or not. That is up to you. But before we jump into that, we did have a number come out this morning, probably the most important monthly number that we have when it comes to economic readings, and that's a CPI, Consumer Price Index. And obviously, as many of you know, it's a basket of goods that the government tracks, and it tells you how much they are up month over month, year over year, to really get a good view of what inflation is really like for the average American. Well, let's just give you the headline numbers here first. Year over year, the CPI number for the month of February came in as an increase of 6%. That is down from 6.4% in January, and is down from the peak of 9.1% that we had back in June of last year. So yeah, we're making some strides when it comes to that. That being said, we do have a lot of negative people out there that are really kind of bashing that right now. But I want to show you a chart here just of the CPI annual rate over really the last 50 years or so. As you can see, we've had some spikes along the way. There's some gray shaded areas throughout that time frame that shows recessions. Even though we're extremely elevated at 6%, we've not been here since the early 90s. You can see the massive pullback that we have had, again, from that high in June when we peaked at 9.1%. And I was pounding the table saying then that it does take time for inflation to come down, but that we had peaked. Is 6% still high? Obviously, look at the chart. It's still very high based on history. All that being said, again, we've come down so much. We've cut over a third of that off from 9.1 down to 6, and it continues to move lower. Again, I just mentioned last month was 6.4. So we've had a massive pullback, and I view this in a bit of a positive light, but we'll dive into that a little bit more. But let's break down the numbers a little bit. The core CPI, which is ex food and energy, was up 5.5% and up 0.5% month over month. The regular headline number was 0.4% month over month, just from January to February. Keep in mind, and I've been saying this for a very long time, that the CPI, where they get it wrong is the fact that about 1/3 of that number comes from shelter. Makes up 1/3 of that weighting. Shelter was up month over month, 0.8%, still at an annual gain of 8.1%. This makes no sense. If you look at rents coming down by any other measure that is up to date, rents have been coming down dramatically. Home prices have been coming down as well. I wouldn't say dramatically, but they've been coming down for several months. Again, I've been pounding this into my daily email, which you can sign up for free. It goes out every day. The market's open. I've been pounding into your head here at the podcast that it's a lagging indicator for whatever reason. I can't answer as to why it's a lagging indicator, why the government looks at numbers certain ways and other research institutions do not. I can't answer. It's just what they do. Keep in mind that the shelter number, the housing number, contributed to more than 70% of the monthly increase. 70% of the monthly increase was due to shelter. When we know rent and home prices are coming down. And I know people get pissed at me when I say inflation's coming down. It's on a good path. And they still say it's way too high, way too high. You know, I heard a great analogy today. I think it was Rick Santelli on CNBC. I know I bash CNBC all the time, but I really do like Rick Santelli. I think he's a very smart individual. He was talking about when he walked into his house and it's 90 degrees. You turn the thermostat down to 60. It doesn't go from 90 to 60. It goes from 90 to 89 to 88 to 87. It takes time. Just like losing weight. If you lose 15 pounds, it doesn't happen overnight. Well, maybe if like you're all these celebrities taking this Ozempic or whatever the hell this stuff is people are taking these days. They're like, everybody's getting skinny. The easy way, the lazy way. But my point is, inflation just doesn't go from 9.1 down to 2 to 3. It just doesn't happen. It has to go along the way. And it's going. It was just 6.4 in January. Now we're down to 6. And again, when these shelter numbers start reflecting the true shelter numbers, this number will dramatically fall off a cliff. That's why I still think we probably see 3 to 4% by the middle of this year, end of summer at the latest. Then what? We'll go from there. So some other prices that were rising as well. Food was still up slightly. Recreation, household furnishings also up. We did have natural gas prices, energy costs. They did come down. Used vehicle prices. People love to talk about this. When inflation really started back in 2021, we saw a huge spike in used car prices. In February, it fell 2.8% versus January. So month over month, that's a big drop. And now on a 12-month basis, used car prices are down 13.6%. So we're starting to see some of the big numbers that drove inflation higher earlier on really come down. So really, what's next here for the Fed? Because we had the CPI number just last week. The Fed funds number was basically pricing in over an 80% chance that when the Fed meets next Tuesday and Wednesday, next Wednesday, March 22nd, is when they will announce their decision on interest rates. There was over an 80% chance last week that they were going to raise interest rates by 50 basis points, 0.5%. Well, that has dropped dramatically. Now it's down to, I think, about 80% that will have a 0.25%, so 25 basis point. But there's a lot of people out there that are saying we're going to have nothing, zero. And that's because of the banking situation, which I'm going to talk about here in a minute, but after I cover the rest of CPI. Just to give you an idea, some of these big firms came out. Barclays came out. Last week they came out and said, okay, we're going from 25 to 50 basis points for the rate increase happening next week. Now they completely turned to saying they don't think the Fed's going to do anything. Goldman Sachs this week said they no longer expect the Fed to raise interest rates at all in March. Again, due to what's going on in banking. Bank of America, Citigroup still believe there's going to be a 25 basis point cut. So it just kind of shows you that nobody really knows. They're changing literally from week to week. Some went from 25 to 50 last week to 0 now, all in a matter of 2 weeks. That's some big, big changes. So that just shows to me the government I don't trust at all. The Fed I don't trust at all. Who the hell knows what's going through their mind right now? And keep in mind, there's a lot of numbers that the Fed's going through. The CPI number from today, obviously the banking situation we're going to talk about in a minute. And then also we had the jobs number last week for the month of February, where we saw jobs, 311,000 jobs were added, unemployment rate at 3.6%, which still is pretty damn good, actually really good employment numbers. So they have to deal with that as well. So we're going to have to see what happens. And keep in mind that the Fed has hiked its base policy from basically 0 to 4.5 to 4.75%, the fastest ever. So they've been really pedal to the metal. Could they take a break here? Sure. I think they're still going to do 25 basis points next week, unless something dramatically changes in the housing, in the banking numbers. I still think that's going to be the situation. So what does this have an effect? Basically, what's happened with Powell last week being overly hawkish, in my opinion, then going to the banking crisis, now to where we are today. Well, the yield on a 10-year bond on March 2nd, so what's that, 12 days ago, less than 2 weeks ago, peaked at around 4.09%. Yesterday, it came all the way down to 3.41%. We're at 3.67 now. So that's basically pricing in the Fed not doing much. Also, when prices of bonds go up, there's a lot of buyers, yields come down. It means a lot of money went into bonds as well. What about the 2-year yield? It was as high as 5.08% on the 8th of March, so less than a week ago. Hit a low yesterday, 3.99, one of the most dramatic and fastest pullbacks in yields ever. Now it's about 4.36%. So we've seen some really crazy movement, folks, in the last just week and a half, in stocks, in bond yields, in Bitcoin. You know, Bitcoin's down below 20,000. Now we're back above 25,000 in Bitcoin. That is a hell of a move. And you would think with looking at, this banking situation, again, we'll talk about it in a second, that would scare people. We'd have this risk-off trade away from risky assets. If anything, it drove money to Bitcoin. It took it again from below 20,000 to trading right now at 25,875, just below 26,000, just below what I would consider a major breakout for the world's largest cryptocurrency. In the last 24 hours, Bitcoin is up 12.2%. In the last week, it's up 15.7%. Ethereum, which is number 2, in the last 24 hours, about 7%, about 11% in the last week. And really, you've seen kind of the big dogs, the biggest ones, have the biggest moves in the last 24 hours and last week. And you're seeing the money go into what maybe it's a safe haven of cryptos, but you're seeing a ton of money going into cryptos right now. And obviously, I own Bitcoin, Ethereum, a bunch of altcoins, and I'm happy to see it, obviously. And I think it's really just good for the market overall to see that people aren't completely panicking. So I am happy to see that action there. So again, we're going to jump into the banking situation in a moment. Let's take a look at the charts real quick. Here's the SPY, the S&P 500 index. As you can see here on the right-hand side, this is that white line I've drawn several times. That was a downtrend line, which is now the support for the uptrend line. And we blew through it in February, pulled back, tested, rallied, and then we had the banking crisis last week. And we closed below it barely, a couple ticks. The last 2 trading days, we're up today about 1.6%. It's only about 45 minutes into trading, about 10:15 East Coast time right now. But you see huge volume the last 2 days, obviously, with people panicking. But at the high today here today, and if we get a hold this, for the most part, it's holding that. And all things considered, folks, when you think about all the craziness that we have had, let's go back to the last month and a half, with inflation still in a lot of people's minds hot, banking crisis. We had Bitcoin fall below 20,000. We had jobs numbers still strong, which is making the Fed be more hawkish. We had the Fed last week, aka Jerome Powell, being extremely hawkish. Just a lot of crazy stuff going on in the world. Meanwhile, the S&P is trading off its 7-8 month high. It's only down 4-5% or so, 5.5% from that multi-month high. You would think it'd be down much more. And if we look at the closing price, the closing high of last week to where we are today, we're down less than 3%. I would just think that we would be seeing so much more right now, so much more volatility and actually a bigger pullback. And one more chart I want to show you here before we jump into banking. Here's the VIX, folks. This is the CBOE volatility index. And you can see here a major spike. It went from 18 up to nearly 31 on the fears of the banks collapsing. Down today about 10%, back down about 23.69 right now. But that spike was the highest level we've seen since October. So we definitely saw a huge influx of fear last Friday and yesterday being Monday as well. But the fear is being calmed a little bit by exactly what I'm about to talk about right now. So let's jump into it. I'm sure you've heard a lot, read a lot, talked to people about it, but I'm going to give you, I think, a different view of what happened here. And, it all started with Silicon Valley Bank, SIVB is the symbol, last week. At the time, the 16th largest bank in the U.S., second largest bank failure ever since the Great Financial Crisis in 2008. Friday, the FDIC came in, basically took over the bank, and they're running it right now. And if you think about it, at its height, it was about a $200 billion bank and a $23 trillion banking industry. So I never really had a concern that it was going to be the systematic risk that was going to spread. I didn't think it was going to spread to many other places. That being said, Signature Bank, SBNY, a New York-based bank, was taken over by New York regulators. So it's also being run by the government right now. And this quote came out Sunday night, and this came out as a joint statement from the Treasury, the Fed, and the FDIC, saying that we are also announcing a similar systematic risk exception for Signature Bank, which is closed today by the state charting authority. All depositors of this institution will be made whole. That's the key there. As with the resolution of Silicon Valley Bank, no losses will be borne by the taxpayer. That we could debate till the sun goes down and up and down and up. I'm not going to get into that right now. But Signature Bank had a lot of exposure to cryptocurrencies as well. It was one of the banks that worked with them. At the end of 2022, they had about 110 billion in total assets and about 800 or 88.6 billion in total deposits, according to their filing. So decent sized bank, but it was a regional bank, and so that kind of piled on. That came out Sunday on top of what happened, obviously, Friday with Silicon Valley Bank. So what happened? Why did this come about? And the way that I look at this is there's different situations for all these regional banks, even the major banks. But your depositors, you and I, put money into a bank, and we're insured by the FDIC up to $250,000. Anything above and beyond that's not insured. So you're up to $250,000, which the average American does not have that. So you're fine. This run on banks, or we want to call it, doesn't affect you. It affects you because the stock moves and everything, but doesn't affect the fact that you need to run out and find a new bank because you're concerned about that. It doesn't affect you in that light. But what I do believe happened here is the fact that, as I mentioned, the Fed's raising interest rates at the fastest pace ever. And when you have the bank backing your deposits by investing in U.S. bonds, a lot of that, as rates go up, the value of those bonds go down. As the value of those bonds go down, that collateral that's backing the deposits is worth less. So that bond they're being held is not trading at par, dollar for dollar, it's trading 70 cents, 80 cents, 90 cents to the dollar. When we're talking billions of dollars, it's a big difference. So as long as the money stays in there and there's not a run on the banks will be made whole because that money is backed by the full faith of the U.S. government. Unless the U.S. government falls apart, then we got bigger stuff to worry about. That's your bank account doesn't matter. You got guns, ammo, and everything else, food, water. Let's assume that the full faith and backing of the U.S. government. They will pay out part of those bonds. So they will be made whole and still make the interest that they locked in at that time. However, if people start getting concerned with the backing of that, if there's a liquidity issue, you have this run on the banks, people start getting their money back above the $250,000. Maybe it's $200 million. Maybe it's $2 million here. The bank then has to sell these bonds at a loss. So they're losing money. And that's a situation that happened with SVB. So they had to start selling their bond portfolio, a large portion of it, 90% of it, and they took a big loss. They had a $21 billion bond portfolio sale where they lost about $1.8 billion because they were forced to sell before maturity and bonds were trading below par. Now, to cover these losses, they announced they're going to do a $2.3 billion secondary offering, share sale, which was to bring in more money. So that fear led to more fear. Then you suddenly had guys like Peter Thiel, one of the largest venture capital guys out in Silicon Valley, sending out emails and letters to his companies and portfolios saying, pull your money out of Silicon Valley Bank. Because Silicon Valley Bank, as you can imagine, catered to a lot of the VC world, venture capitalist world, and the startups in California. So then you have this run on the banks, and suddenly they can't get the cash out. And that's where the government stepped in on Friday. So do I blame the bank for not kind of hedging correctly with the assets that they had? Sure, I could put some blame on the bank. Do I blame the venture capitalists? Tough to blame them. Half of the world wants to blame them, the other half doesn't. I don't feel like they should be gloating out there right now because they got made whole. I mean, when you take big risks, you take big risks. But you should still feel safe putting your money into a large financial institution, the 16th largest bank in the country in Silicon Valley Bank. So I kind of go both ways. But I believe that Peter Thiel and some of his cohorts were basically yelling fire in a crowded movie theater. Everybody running for the exits can't get out at once. And that causes the run on the bank, which causes the situation that we just had. Fortunately for him and his buddies, they happened to be at the exit door when they yelled it. They were already getting out. They were fine. They got their money out, then yelled it. So, you know, there's a lot of ways to look at this. We get passed the blame around all over the place. So then, of course, then we move ahead to Monday. The government comes out. President Biden came out in the morning and said, hey, listen, we're backing basically all these banks, and you will all be made whole as depositors, meaning that, you know, they have the money there and through FDIC insurance. So these banks pay in insurance to the FDIC. That's why the FDIC is there. That's why they can back you up $250,000. But they're saying they're backing up all deposits. They're making everybody whole because the money they're paying into this quote unquote insurance company, government run insurance company, if you will. So that money going in there, that's being used. So I get that. And, you know, obviously government officials now on the left are saying this will not hurt taxpayers at all because it's not coming from the taxpayer. It's not a true bailout. Again, this is up for debate. We could talk about this for hours or days or weeks or months or forever. You can call it what you want. In my opinion, yes, I see the argument that taxpayers are not directly paying for this. However, what this is going to cause, in my opinion, is it's going to increase these fees, these deposit fees for money, because the FDIC is going to want more. The banks are going to want more to pay the FDIC for higher insurance. So essentially, Silicon Valley Bank, Signature Bank, they totaled their cars. So the fact that they totaled the cars means that their insurance is going to go up, not necessarily for their banks, but all other related banks, especially probably the regionals, but it might spread to all financial institutions that incorporate the FDIC into their deposits. So to me, there will be some type of pay. Somebody will be responsible for this money that will back up the next bank failure or make the FDIC feel safe enough that they could potentially raise the 250 forever to a higher number. Or basically just say, we're going to bail out any bank that struggles and fails with this money that's come in through the fees, through the FDIC, through the insurance. So again, Signature Bank and Silicon Valley Bank crashed their cars and totaled them. And it will now cause the rest of the industry higher insurance premiums, in my opinion, which will be passed on to who? You and I. That's who. All right, so let's take a little bit of a positive view here, though, folks. Based off all that's been going on here, there are some opportunities, I believe, and they're going to be a bit random. I'm going to talk about a couple of different areas. One area is what we call short-term treasury ETFs, and these are ETFs that invest in T-bills up to 90-day maturity. So one of them out there is the symbol SGOV. And this is the iShares 0 to 3 month Treasury Bond ETF. And if we take a look at the yield on this and the action, I'll show you here in a minute, it's pretty interesting when you look at what the action as of late. More importantly, it yields over 4.45% on an annual basis. So the 30-day SEC yield as of the time we did this, when I put this together the other day, 4.49%. So here is the chart. You can see obviously it's choppy. It really didn't move at all until last year when we started to see obviously bond prices get a bit wonky. Until then, you just got your monthly payout and it went flat. Well, now you're seeing it's actually moving up in price, which is fine as long as it doesn't go down in price. And then each gap you see each month, that's when you pay, you get your dividend paid. But it still even keeps moving up with the dividend payment. So that's actually really good news when you look at that. So that is one way that you can potentially see more money going into that. And the reason you'd see more money going into that, because that money had to come out of Silicon Valley Bank, had to come out of Signature Bank. It has to go somewhere. One place where it might be to get some yields, which again, that's a pretty damn good yield, and you can pull this money out of your SGOV anytime you want. That might be a place you see some money flow. And there's others that are in that category. There's one that the Spiders does a 1 to 3 month T-bill ETF, symbol BIL, BIL. iShares does a short treasury bond ETF. This is 3 to 12 month T-bills. SHV, which yields around 4.5% as well on a 30-day SEC yield as of a couple of days ago. So you do see some opportunity there. I don't know how long that lasts, but I'm saying you could see some money go into these ETFs. You could also maybe see them go into an intermediate term ETFs, which is about 7 to 10 years. There's the IEF, which yields around 3.8% or so. And you can see here on the chart, this is actually down today about 1% because yields are going back up, as I mentioned, because we've had this wild volatility in yields. But that's one way you could potentially look at bringing in some money, locking in for a little bit longer term. So there will be some money, I believe, that will be moving out of money market funds, out of some of these banks and into some government-backed bond ETFs or government-backed bonds themselves. So I do see some money moving that way. I also see some money going into these large financials because if you're taking your money out of SIV, Silicon Valley Bank, or Signature Bank, that money's got to go somewhere. And that money is going to go into a place where, honestly, that you probably feel a bit safer. And I think a lot of people will feel a bit safer in the JP Morgans, the Wells Fargos, the Bank of America of the world, 3 big ones. And Wells Fargo, for example, overly capitalized because all the crap they went through in a great financial crisis and ever since then. So you might be able to kind of see them really go after some deposits at Wells Fargo. That being said, Wells Fargo stock has done nothing over the last couple of months here. I'll show you a quick chart. And it's only up, and it's up today 4.7%, but not far from a low. Pulled back, obviously, with everything else, but really hasn't done much over the last few months. Where if we take a look at Bank of America, BAC, very similar chart, hasn't done much. Actually hit a year low yesterday and up about 1.8% here today, bouncing with the rest of the market. But I do think that they could become a beneficiary of this longer term as they attract more money into the what you can call the too big to fail, very large financial institutions. I also think there's a lot of opportunity in the regional banks. You have to be very picky, but I still believe 95% or so, if not more, of the regional banks are adequately capitalized and don't have a liquidity issue. That being said, the KRE fell from 65.5 in early February down to 42 yesterday. So it got crushed. It's back to 47.84 right now, about 7.5% today. I think there's a lot of opportunity there. But you have to do due diligence. Make sure you're looking at what kind of backing that their deposits, which is very difficult for the average investor to do. Another way to do it is maybe you look at an ETF. I personally yesterday put together what I call my financial opportunities basket. I bought into 3 regional banks, two broker dealer type companies, and 1 large financial institution. So I saw some opportunity in that, and I just checked it honestly before I came on here, and I believe in less than 24 hours it's up about 4.5% right now. So it's got a nice little bounce in 24 hours. I'm probably looking to hold for longer term, but I saw some opportunity in the pullback yesterday. All that being said, folks, I still think we could see a lot of volatility. I still think we can continue to see headlines come out that shakes the market. Don't forget, we still have PPI to come out. We still have the Fed decision next Wednesday, the 22nd of March. We have a lot of things out there that can move this. We don't really know exactly what's happening with the regional banks yet. We don't know if this kind of trickles down to others. We don't know how this affects the large financial institutions. Does this trickle down to some startups in Silicon Valley and some tech innovation companies that had their money there? It shouldn't, because they said they're going to be made whole, so it shouldn't matter. None of this stuff should matter. But you never know what headlines can do, especially day to day, week to week. It can drive the market absolutely bananas. So please keep that in mind. So one more last look here at the KRE. This is the Regional Banking ETF, as you can see, up about 7.6% today. Not the middle of the trading range. And we'll take a look at the SPY, the S&P 500. The high today right now, just under 2% right now at 392.95. And again, holding above that downtrend line. So all this being said, all this wackiness, all these headlines from the jobs to the bank failures to the CPI, and the market's about 3% off the 3.5-week high that we hit a week and a half ago. I don't know. Sometimes the market is just, you let the price action tell you what's going on. You can't overthink things too much. But that's it being said, folks, I think there's a lot of great opportunity out there. But please do your homework, do due diligence, because it's not that easy. It's a tough market. But if you do it and you find some good opportunities, like I think I did yesterday, I think you could be really happy in a few months from now. But once again, go out there, be safe, enjoy life. Thank you so much for watching. This was Making Money, and I'm Matt McCall.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.